Hello, welcome back. I hope you're having an awesome day. We're gonna be taking a look at Netflix right before they release their earnings today. It's actually at the end of the market, I believe, end of day. And so I wanted to take a little bit of a closer look. And if you know me and if you have examined my previous videos and if you have been on the channel for a while, you know that I'm generally speaking not a huge fan of companies that utilize huge amortization. And I feel that it can be a little bit difficult to actually properly evaluate and expect to get some returns in the future. It can be a little bit of a weird game to play, and so typically I tend to avoid holding these kinds of media companies for the most part. Now, this one obviously is a favorite of people, but it's been down 52% almost, massively down from its highs. It used to be $700 pretty much, and now it's half that, less than half that. So has been doing pretty terrible in the past year. But as you will see here, from its IPO days, it has been rocking. I mean, it has been climbing higher and higher. The problem is, will they continue achieving profitability or go back to their pre-COVID era where they were actually losing money? And what about their revenue? Will they be able to increase their revenue? Will they be able to increase their business? Because remember that there is a lot of competition right now in this kind of streaming platforms. And also, people are getting a little bit more aware of what they are spending these days just because there is more inflation. It's actually more difficult for the average family to get on the products that they need and all that. And so this kind of company is mostly about a product or a service pretty much that we don't really need but we like. And so the less money we have and the more the inflation goes on, this can be a little bit of a problem for a company of that sort. Now, that said, let's take a look at what they are doing financially. The P ratio of the company has been going down a lot, especially after they have been, losing a big chunk of their stock price. And this is why it's actually sitting at 30 right now, which I think is probably close to being okay for a company of that sort. But we want to examine all the other details as well. You will see that the price to free cash flow ratio is massively in the negative here, which points to a company that's not really making free cash flow. It actually used to be positive at some point, yet pretty high, but now it's actually in the negative, meaning that they are losing money or free cash flow. The outstanding shares here, they are actually issuing a little bit of shares here, not something insane. 3% in 5 years, I think I'm okay with, although I would definitely like to have less shares, less outstanding shares. I can understand them, issuing a few more shares, especially at these prices. I would myself potentially even have issued more, to tell you the truth. But this is not a massive concern. What about the free cash flow to total liabilities though? Look at this one. They seem to be having massive total liabilities and pretty much no free cash flow to handle these total liabilities. Now again, you have to remember that this kind of company has liabilities that get amortized through years. And the way this works is basically when you're producing a movie, you can amortize its expense through like 4 or 5 years. I believe Netflix were using 4 years, if I'm not mistaken. But typically speaking, you actually see a chunk of that money, like 25% every year, pretty much getting amortized. And an amortization is basically depreciation for intangible assets. That's what it is. So 5-year revenue growth here, the company has been increasing its revenue, so that's a good thing, and its net income, that's another great thing. Not as much their free cash flow, and the total equity has also been increasing here. In terms of their debt to equity ratio, it's a little bit more elevated than what I would like it, but not massively more. They do have a great return on equity though, 35%, that's pretty good. And net income margin of 17% here, a current ratio that's a little bit lower than what I would like. But let's take a little bit of a closer look at the financials here, see what the company is all about. 11 billion in 2017, 29, almost 30 billion in 2021. So massive growth here for the company. I'm not sure they will keep achieving that every year from now on. Again, lots of competition coming their way. From 500 million to 1.116 billion here. Another great increase in net income. So that's good to see for the company, of course. And what about their balance sheet here? Let's take a look at their total equity here, 3.5 to 15.8. And liabilities of about $29 billion. So they are increasing their balance sheet fairly nicely here as well. The net cash provided by operating activities here is 300 million. you will see massive depreciation and amortization, as you would expect, added back to the cash flow statement because it's a non-cash expense. And as you can understand, if not for this line, everything would be negative here. But this is actually extracted from the net income. This is how it works, because it's a non-cash expense, but it is an expense. And so this is why it's added back to free cash flow over here. This is why these companies can be a little bit tough to analyze, because they have this kind of adjustments pretty much every year taking place. You will see that the company has been increasing their amortization expenses here, pretty much pointing to the company producing more and more expensive products, really, like movies and the likes. So the cash from investing activities here has been negative. The company is investing a little bit, nothing too dramatic. And in terms of financing activities, also negative this past year. For the most part, paying some debt, as you'll see here, repurchasing some common stock also is interesting to see. And the free cash flow is in the negative right now in 2021. Their only positive free cash flow year was back in 2020. I guess you can understand that because of the pandemic, people were watching way more movies and series and all that. And you would come to expect that a company that has been enjoying that much income during the pandemic would not be 50% down, but this happened because it was massively overvalued before that. And this is what the repercussions of this are, really. And let's take a look at our stock evaluation tool here to try to deduce what kind of value we could potentially pay for a company of this sort, potentially after the earnings, after seeing how they are doing on earnings. And you will see here that the revenue growth has been from 18 to 27 pretty much. We have to go a little bit lower here. Let's go 15, 17, and 19. And this is also a little bit doubtful. It may be also confident, actually, based on the competition around. The net income margins 4, 5, 7, 9, 11, 17. It's been getting better. So I'm going to go 10, 13, and 15 here. Now the free cash flow margin is the big thorn here, because obviously the company has been losing free cash flow. That's the biggest problem. And you will see here that the only positive year was in the pandemic, and it was 70%. I don't even know if they will be able to be positive, free cash flow positive again or anytime soon. Maybe, but I'll have to use some positive values, because otherwise, this model, because it's based on free cash flow, of course, and the income that the company generates, won't be giving us results that make any sense. So we have to deduce that the company is potentially going back to this kind of numbers here, like 70%, 50, 60, 70 is what I'm using here. An annual percent of 13%, annual return of 13% is what I want to be making, because I can make 10% out of an S&P 500 ETF. Remember that taking an individual stock for a ride has more risk, and so you need to be making more than 10%. This is why we're using 13, and you may even go with 15 if you have even more risk depending on the company. So I'm going with 13 here, and if I hit calculate, you'll see that we are way off from what we want it to be. And frankly, I would probably be comfortable to buy this company at around $100, to tell you the truth, if not less than that. I think it's very overpriced right now, and imagine how much overpriced it was when it was back at $700. Now, of course, I don't know what they're going to be doing after earnings. It's kind of irrelevant for my analysis here. But I think that kind of helps you understand how these companies become a little bit hyped up, and this is why they're getting valuations that are insane over here. Basically making no free cash flow and trading at minus 8,000 times free cash flow. So that's the bad thing about getting in hype, and this is why I actually do not like buying companies when everybody's buying, because there's a lot of hype and they tend to overvalue them without even understanding that. And so, as you can see that here with the numbers, and the numbers is all that matters really, we don't really want to be buying Netflix as it is right now. We probably want to be buying Netflix, but it has to have an awesome price. And if that doesn't happen, then we never buy. As simple as that. We don't necessarily need to buy any company. We only buy the ones that can provide a nice return for us through the years with as less risk as possible. And that's the whole point of this exercise over here. Hope you enjoyed the video, and let's see what Netflix does in terms of earnings. If it's something important, I'm going to be making another video about it. But please remember to like and subscribe, because very soon I'm opening up this tool for all of you, and I'll let you know how to get access to it. Probably in about a week or so, it's going to open up to people, subscribers, viewers. And if you are a subscriber, you'll be one of the first to know, of course. And while you are here, take a look at this video that I made about SAP, a well-known HR resources management company, which is interesting to at least examine and see whether it fits your portfolio. Thank you for watching this one, and I'll see you in the very next video. Bye bye.